The Federal Reserve are about to start cutting interest rates. Labor market data that has come out over the past week has all but guaranteed that the Fed will start cutting rates. In this video, I'm going to break down what that data is, why it tells me that the Fed is going to start cutting interest rates, and why you should be so convicted as a crypto investor in this upcoming bull run. You know the drill. Like and subscribe down below, and let's jump in to today's video. Now, investors over the past month have been wondering whether or not the Fed is going to cut rates at the upcoming FOMC later this month. The dilemma is that the Fed has inflation moving away from the 2% target. It's going higher. On the other hand, you have the labor market breaking down. It's going lower. And so this is the dual mandate. They have to determine whether they want to focus on inflation or whether they want to focus on the labor market. Now, the Fed previously has said that they are waiting for tariff data to come through before they cut rates. We've seen that data come through. Tariffs are not contributing durably to inflation. We've been over this. But we are seeing the labor market deteriorating. And so now the Fed actually has a duty to focus on the labor market instead of inflation. This is going to cause them to cut rates. And so I got a quick clip to help clarify this. I got JP Morgan's Gabriela Santos. She's going to explain that the Fed is now looking more at the labor market as opposed to focusing on inflation. Check out what she has to say.
I was going to say, it feels like the Fed is a little more focused on the labor market side of things right now than inflation, because inflation, they've been waiting and waiting to see what happens. It hasn't gotten kicked into high gear by the tariffs as some people had expected. But the labor market cooling, that's got to be something that's catching their attention.
Absolutely. And I think it was that July jobs report with the lower revisions, over 254,000 lower revisions to May and June, that really for them brought into balance more the labor market and the inflation side of the equation.
And so as she said, the Fed is now focusing more on the labor market. Have a look on your screen. Let's go over this data real quick. These are some of the bigger data points that came out yesterday on Friday. We had non-farm payroll, employment change. Look at these numbers. This is significant weakening that we're seeing. The expectation was 75,000 jobs added. We only had 22,000 jobs added. The unemployment rate rose by 0.1% from 4.2 up to 4.3. Now, this was expected, but still, this is a big deal. The unemployment rate is the Fed's preferred gauge of understanding the labor market. This is something that Chair Powell speaks about during his FOMC briefs. He always talks about the unemployment rate. This is really what they look at. And so the unemployment rate going higher, along with a big miss when it comes in lower than expected and it's a bad thing for the economy, we call that a miss. And so we had a big miss this week in the non-farm payrolls, down almost 65% from what they were expecting. They were expecting 75, they got 22. That's a big number. And so what we see now are the chances of a Fed rate cut going higher and higher. Have a look on your screen. We've got the percent chances of rate cuts here from the Fed CME Watch Group, an 89% chance of a 25 basis point cut and a 11% chance of a 50 basis point cut. The data that we've seen throughout the week, the Bayes book, the JOLTS report, and other pieces of data showing us what the labor market is doing have shown it's getting weaker and weaker. And so the chances of a rate cut have been going higher and higher. With yesterday's data, the unemployment rate and the non-farm payrolls rate, these are the most important. This is what the Fed watches the most. And so when those came out very weak, the chance of a 25 basis point cut actually went above 100%. And so now we're in 50 basis point territory. For me, this is actually a better chance than 11%. I would personally give this about a 25 to 30% chance, because this is exactly what the Fed did last year. In September of 2024, they waited until the labor market was showing weaker and weaker data, and then they cut by 50 basis points. Why do they do this? They do this because labor market weakening is non-linear. And once it starts to get away from you, it can get away from you fast. And it can spiral into something called the layoff cycle, where companies and businesses aren't doing well enough, so they have to lay off employees. Well, these employees who get laid off, they have to spend less because they don't have any money. They're not making any money. They're on unemployment, or they're not able to get unemployment, so they go out and they spend less. That affects businesses. And so businesses are starting to make less money because less people are buying things. They have to start laying off employees. And on this cycle goes. It can get bad fast. And if a layoff cycle starts to get going, it's devastating for any economy. This is what the Fed wants to avoid at all costs. And no one understands that better than Mohamed Alarian. He's one of the best macro analysts in the world. I got a brief clip from here. He's going to break this down. He's seeing the same thing that I am. Check out what he has to say.
You know, there was a bunch of us outside and inside the Fed that were arguing for a July cut. And our concern, which is playing out in the data, is that Chair Powell had taken too narrow a view of the jobs market. And by that, he was ignoring the weakness that was starting to come to the surface. And the problem, as you know, Brian, is if you don't address weakness in the labor market, it becomes non-linear. It accelerates and it becomes much more damaging. So yes, I think they have gotten it wrong. I think once again, they're late. They will cut in September. And I suspect there will also be a discussion, should they cut by 25 or 50? And where you end up on this depends on whether you think the labor market has a demand or supply problem and what you think the inflation dynamics really are.
And so, as Alarian said, the economy now is in a worse place than it was last year. And so the Fed, I think, is very likely to do 50 basis points. The only thing that could stop them from doing 50 basis points, I believe, would be high inflation data coming out next week. We're going to do a video on that, so stay tuned for that. But CPI data, the Consumer Price Index, is coming out on September 11th, and that's going to tell us what inflation is doing. That's going to be the final inflation data that we get before the FOMC. So if that data comes out relatively muted, if it comes out at or below expectations, I think 50 basis points is a go. That's just my personal opinion. Do with that what you will. That being said, regardless of whether or not the Fed does 50 now, 25 now, does 50 and then 25, I think that one rate cut signals that there's actually more rate cuts coming. The Fed doesn't usually just do one rate cut. Typically, if the Fed's going to cut rates once, they're going to cut rates a couple times, maybe 2 or 3 times. It's a rate cutting cycle. It's that they've looked at the data, they've examined the economy, and come to the decision that the economy needs lower rates. And there's actually a solid argument as to why the Fed would cut multiple times. I got Jeremy Siegel here. He's a professor at the Wharton School of Business. He's going to explain his perspective, why he thinks the Fed could cut several times over the next few months. About 30 seconds, have a listen.
And, you know, you can't say whether there's going to, I mean, I really think there could be 1, 2, 3 for the next 3 meetings. Because I really think that, you know, what the Doves want is to get down to near neutral, which is the 3%, 3.25% range. And that's eventually 4 cuts by, let's say, the middle of next year. I mean, I think the Fed funds rate, as I said many times on your program, should be about 100 basis points below 10-year. And we're about 4.25 on that 10-year. So, you know, 3.25 on Fed funds is the direction we should be heading for in the next, you know, 6 to 9 months.
And this is actually what the Fed did last year. The Fed cut by 50 basis points last September, and they followed it up with more rate cuts. Have a look on your screen. Pull it up on TradingView. I've got the total crypto market cap, excluding the top 10. This is basically the altcoin market. Have a look here. This is when the Fed cut 50 basis points. We had an October meeting, and then look, we went crazy. We went absolutely crazy. And then this was, you know, this was Trump winning the election. And then obviously we sold off into the new year. We all know how that went. Let's not rehash painful memories. But essentially what we're seeing here is a 50 basis point cut, a rally up, and then here, right around here, we have another cut, and then we have another cut here. We stalled off, and then we dipped because all of the tariff news and then all that happened there. So, and then now we're trending back higher, and we're coming up to September again, where we could see another 50 basis point cut. If that happens, I mean, look at where we went. We went from down here all the way up here, and now we're starting from here. Could we go up here? Could we go all the way up here? Would be nice. I think that it's a possibility. I think this is something that could definitely happen. It makes me bullish, and I hope it makes you bullish as well. And if you want to remain bullish and stay up to date on the probable distribution of economic and policy outcomes that are likely to affect crypto and digital assets in this bull market, you got to stay tuned to the channel. Like and subscribe down below. Leave a comment. Tell us what you've learned. Let me know what you're bullish about this crypto bull run. And as always, we'll see you in the next one.